Ever wondered how you could potentially profit from market movement without owning the underlying asset? Welcome to the world of contract for difference, or CFD trading, a realm where traders speculate on the rising or falling prices of fast-moving global financial markets. From shares to indices, commodities to currencies and treasuries, CFD trading is a gateway to them all. It's a universe that thrives on the pulse of the market, and it's within your grasp. Let's dive deeper into some strategies to help you get started with Index CFD trading. Before jumping into the strategies, it's crucial to grasp the basics. Let's start by understanding the key terms in CFD trading. First up, leverage. This is a tool that allows you to trade with more money than you actually have in your account. It's like a loan from your broker, and it can amplify your gains, but also your losses. Next, we have margin. This is the initial deposit required to open a trade. It's a small percentage of the total trade value, and it's there to cover any potential losses. On to positions. A long position means you're buying an asset with the expectation that its value will rise. A short position is the opposite. You're selling an asset expecting its value to drop. Lastly, we have stop-loss orders. These are instructions you set to automatically close a trade if it reaches a certain loss level. They're essential for managing risk. Now, armed with the basics, it's time to explore some beginner-friendly strategies. Our first strategy is all about long-term trends. When we talk about long-term trends, we're referring to the overall direction in which the market is moving over an extended period. This could be upwards, downwards, or even sideways. The goal here is to identify this trend and then open and hold a position that aligns with it. Now, this might sound relatively simple, but it requires a great deal of patience and discipline. Why? Because markets don't move in a straight line. There will be days when the market moves against your position, but it's important not to let these short-term fluctuations distract you from the broader trend. To successfully employ the long-term trend strategy, you need to be able to differentiate between short-term noise and long-term movements. You also need to be disciplined enough to stick with your strategy, even when the market seems to be moving against you. Remember, the key to this strategy is identifying and following the trend. The second strategy we'll discuss is contrarian investing. Now, this approach is a little like going against the tide. It involves taking positions that are opposite to the prevailing market sentiment. Essentially, it's about buying when others are selling and selling when others are in a buying frenzy. Sounds risky, right? Well, it can be. However, it's not just about taking a contrary stance. It requires a good understanding of market psychology. You see, markets often overreact to news, both good and bad. And that's where contrarian investors see opportunity. They believe that the market will correct itself over time, and that's when they stand to profit. But remember, contrarian investing isn't for everyone. It requires strong risk management skills. You need to know when to get in, but more importantly, when to get out. Contrarian investing can be risky, but with good market understanding and risk management, it can be profitable. Before we wrap up, let's talk about the most crucial aspect of CFD trading: risk management. Risk management, my friends, is the cornerstone of any successful trading strategy. It's the safety net that protects you from financial pitfalls and keeps your trading venture afloat. In the world of CFD trading, it's not just about making profits. It's equally about minimizing losses. Imagine you're a tightrope walker. The stop-loss order is your safety net. It automatically closes your position if the market moves against you, limiting your losses. Setting a stop-loss is like telling the market, "This is as far as I'll go." Diversification, on the other hand, is like having multiple safety nets. It's the act of spreading your investments across different market sectors or instruments, reducing the impact if one of them takes a tumble. Remember the old saying, "Don't put all your eggs in one basket"? That's diversification in a nutshell. Now, here's a golden rule. Never risk more than a small percentage of your trading capital on a single trade. Even the most seasoned traders abide by this rule. It's like a buffer, a cushion that absorbs the shock of a bad trade. But remember, every strategy, every technique requires practice. It's trial and error, learning from mistakes, refining your approach. Even the best laid plans can lead to losses. Understanding these strategies and effectively managing risk forms the foundation of successful CFD trading. Remember, practice makes perfect. Happy trading. All right, folks, that's it for our beginner's guide to mastering Index CFD trading. We hope you found this video helpful and now feel more confident about diving into the world of CFD trading. If you found this video valuable and want to learn more about trading, please give this video a thumbs up. Your likes are a great way for us to gauge what type of content you find most useful. And don't forget, if you want to stay updated with our latest videos and deepen your trading knowledge, make sure to hit that subscribe button. By subscribing, you'll be the first to know when we release new educational content, and you'll be joining a community of like-minded individuals all looking to improve their trading skills. Remember, every like and subscribe helps us bring more quality content your way. So let's grow together in this journey of financial independence. Happy trading, and we'll see you in the next video.